Please chat us in case you cannot hear or you cannot, you lose us at some point. So hello again, my name is Grace Njoroge and I'm a program manager with the MasterCard Foundation Fund for Rural Prosperity, and I'll be your moderator for the session. Welcome to the webinar. The title of the webinar, as you can see on your screen, if you can see, is Alternative Credit Scoring and its Role in Financial Inclusion. And the webinar will present different perspectives from the fund, the MasterCard Foundation Fund for Rural Prosperity. So we will abbreviate it as the fund going forward in the webinar. And we will also feature an expert on alternative credit scoring. And we'll also have two fund participants who are in the fund, who will bring their different perspectives to the conversation. So welcome. And thank you very much for making time to join the webinar. So a few ground rules before we begin. If you lose us at any point, please use the group chat to alert us. And then there's no need to display your video. So please turn off your cameras and also kindly mute your mic until you're advised. This will ensure that everyone has the best experience from the webinar. In terms of timing, we estimate that the webinar should take a little over 1 hour. And in case of any technical issues, please chat us on the group chat, or you can chat privately with Grace Oduor, who was the organizer for the session. And then lastly, please take note of your questions as each presenter speaks and send them on chat, either on private chat to Grace Oduor or to the group chat. Please do not interrupt the speakers. We have a short period, so we'll keep the questions till the end, and everyone will have a chance to get their questions answered at the end of the session. So our speakers today is the fund represented by Wambui Chege. We have Howard Miller, who's representing Nathan Associates. And we have Musoni, which is represented by Juliet Ongwae. And we have Fast Access, represented by Nicole van der Twijn. So I will introduce each of the speakers in more detail before they speak. So to start us off, we have Wambui Chege, who is the team leader of the Fund for Rural Prosperity. And Wambui has managed a broad range of programs focused on agri-finance, SME banking, and the development of sustainable and inclusive agricultural supply chains. She joined KPMG from the International Finance Corporation, where she was responsible for design, delivery, and monitoring of technical assistance programs to various financial institutions, agribusiness, smallholders, and governments across Africa. Wambui is the current team leader of the MasterCard Foundation Fund for Rural Prosperity, and she's also the KPMG Director for Agribusiness, responsible for growing the agribusiness portfolio within KPMG. Wambui, welcome. Wambui will present an overview of the fund and its alternative credit scoring related projects. Welcome, Wambui.
Thank you. Thank you, Grace. Hello, everybody, wherever you are in the world. Good morning, good afternoon, good evening. It's a real pleasure on behalf of the Fund for Rural Prosperity to really have our first webinar. We are planning to host a lot more, and over the course of today, you're going to know the reason why, so stay tuned as well. So without further ado, I'll go straight into giving you an introduction to the fund and what we've been able to achieve so far in the area of months of design, and we are now in our 4th year of operation. It is funded by MasterCard Foundation, and KPMG, it is managed by a consortium of firms, consulting firms led by KPMG. Our partners in the consortium are Nathan Associates London, as well as IPE Triple Line. Both of they all play a different role in the fund. We are now in our 4th year after a very intensive period of getting applications, as well as reviewing them and allocating funding, and it's been very exciting, especially from towards the end of last year and this year, to see the results starting to stream through, especially from our first cohort and our second cohort of participants. So we have about 38 companies in total that we have funded through the fund, and 56% of these companies are located or are implementing in Kenya. So it was not deliberate. It was just really a function of how the number of applications that came through, as well as the selection process. But we really tried our best to be as inclusive and as broad as possible. We are pleased to have within the East Africa region and broader projects from Ethiopia, projects from Burundi, as well as projects from Democratic Republic of Congo. So going into what kind of impact that we are beginning to see, one of our objectives is to reach 1 million smallholder farmers, and I'm really pleased to say that we are well on our way to achieving that goal. To date, we have reached over 950,000 individual users with financial services, and which means that by the time we finish the program in 2021, we will definitely have exceeded that number. It would be wonderful to reach even 3 million or 4 million or 5 million, and I do not think that is impossible given the level of innovation that we have seen. Customers get technical assistance on how to use the financial using as well, whether this be in the financial literacy or even agronomic support. And we're happy to say that at least a third of the users that we have reached actually have received some form of training. And it really points and alludes to the fact that partnerships are really important, and it's very important to deliver technical assistance in conjunction with the financial solution. As I said, we have 38 projects that we have supported. A number of them are coming to an end this year, and we will be, for those of you who are online, who are part of the FRP program, we will be getting back to you and working with you to determine and to assess whether you would be eligible for another round of funding. And finally, one of the other things I would like to highlight is that we have been able to create 750 job opportunities within the companies that we support, as well as on farm. And we have been able to provide support for the loan at least 66 financial products. So when we launched the fund, we anticipated that there would be a lot of interest from financial institutions, but what we never anticipated was the level of innovation that we would be seeing, and a lot of interest, especially from fintech companies. In terms of the solutions that we are seeing, almost all, a big proportion of the products are credit. So credit dominates. However, what is worthwhile to note is that even if credit is offered, it is most typically bundled with other products. It is typically bundled with and transactions and sometimes insurance. And credit is usually, the other products that are bundled together with credit are typically used as an entry point to get the farmer as a customer into the financial institution. And you will hear some of that and how that process works from the partners that we're going to have on board. So just a selection of the companies that we're funding who are providing alternative credit solutions. So I was reading somewhere actually that we have entered into one of the most profound eras of change for financial services with the rise of fintechs and with the rise of big data. And you can definitely say this is true, because one of the big questions that we had, even as we were designing the fund and launching it, and as companies were coming to us for funding, is how really do we lend to farmers who have no relationship most of the times with formal financial institutions. We don't have a lot of data on them. We don't also know how to speak their language, or as customers, we don't even know how to reach them and serve them as a market. So what I would say as a fund manager is, first of all, we salute all the companies that we have funded through the FRP, because they have really taken a bold step to try and solve this riddle. How do we reach the customer in the rural area? It's not easy, and we understand that. There is a lot of innovation, and I'll just pick a few highlights. This presentation will be available afterwards, and you can have this data for your information. So one of the companies that we funded is a company called Juhudi Kilimo, which is a microfinance institution that is based in Kenya. And Juhudi had an interesting model for gathering alternative data, which was based on psychometric credit scoring. They were hoping, and they hope, to move from group lending with psychometric to individual lending, and especially in the rural areas. The other interesting group of companies is companies which were looking to establish credit bureaus. And for that, we had a company called Compiscan, which, as you know, is one of the biggest credit bureau companies on the continent. However, they hit a hitch in Uganda, where they got into problems with the regulator, and we've been working with them to support them to see whether they can establish a rural credit bureau that would provide credit data to microfinance. So really wholesale that information and wholesale that solution to other financial institutions. We also have other companies that are using very technical and high-end solutions to gather data. So institutions like Apollo Agriculture, Pula, a company in Ghana called Psycomp, who are all using remote sensing, GIS mapping, machine learning, drones to even collect data, as well as satellite imagery. So we're really excited about these companies, because we believe that this is the future, and we're looking forward to seeing the data that is going to come through with these projects. A final set of providers are solar pay-as-you-go companies. So what is interesting about these companies is that they are now providing ag products as their next generation. So where you have borrowers who have paid off their solar system, and they now come back to use it as collateral. So what these companies are doing is they have a wealth of data, payment information on the customers, and they're using this to develop credit scoring models, as well as understanding payment behavior, to develop credit scoring models for their customers and offer them additional products that would increase their productivity on the farm. So very exciting. Finally, we've got farms such as Copia, who we find is a really unique company on the portfolio, because they call themselves an Amazon for rural Africa. And farms such as this, as well as some of the agribusinesses that we are supporting, have decided to develop their own credit systems to provide credit scoring systems, so that they can be able to provide lending products to their customers, in addition to the services that they already provide them. What remains to be seen is whether these institutions will house this credit team in-house, whether they will sell that information at a later stage to financial institutions such as MFIs. And that's something that we will be tracking and following very closely, also to see whether there is appetite in, for example, in the market for this kind of data. So with that, I'm going to hand it over back to Grace, so that we can move on to our next speaker.
Thank you, Wambui. That was very informative and a very good start to kick us off with the webinar. And it's also very good to hear and see all the projects that the fund is supporting that are using alternative data and are going to use it going forward. So to continue with the conversation, our next presenter is Howard Miller. Howard Miller is an associate consultant with Nathan Associates, and he's based out of India. And he's worked on projects around rural finance, inclusive fintech, and alternative data analytics for clients including MasterCard Foundation, FSD Africa, USAID, SIGAP, and others. So he previously worked with Harvesting, and Harvesting is a fintech that works on agricultural finance. And he's also one of the people we have on the webinar that was in the team that originally designed the MasterCard Foundation Fund for Rural Prosperity. So welcome, Howard. The stage is yours.
Thank you, Grace. That's great. So yeah, I will, the purpose of, I've got 3 slides, and I just want to kind of frame alternative data credit scoring in the context of the challenges that we as a sector see in lending to smallholder farmers, and talk a little bit about, at quite a high level, about the different models that we're seeing both through the FRP portfolio and more broadly. As Grace said, I was actually in the team that originally set up FRP 4 or 5 years ago. So it's been fascinating to see the range of projects that have come through. And I think that what we'll hear from Sony and First Access will be extremely interesting. So I'll try and get as quickly as possible to them. So I think most of us probably who've worked in this space for any period of time understand that lending to farmers, particularly lending to smallholder farmers in particularly rural parts of sub-Saharan Africa, is extremely difficult. You have all the challenges that we have in financial markets, all the challenges we have in agricultural markets. The intersection of there, we have a whole load of constraints, and we think of how the lending process works. Pre-loan, we have challenges in identifying who we want to lend to. What are their behaviors? What do these segments look like? What are their needs? What are their demands? How do we understand their behavior? All of these things that a bank or an MFI or a fintech needs to actually understand if it has any chance of building a profitable business model. And then once the loan is made, post-decision as well, there's a lot of challenges around loan management, collecting on repayments, the ongoing transactions with borrowers. That is difficult in remote areas, sparsely populated areas, low technology areas. And then at the point of decision making, how do we calculate the risk of lending to anybody, but particularly a smallholder farmer in a low data environment? How do we manage that risk, and how do we cope with the significant transaction costs of serving these customers? And the point to make here, we can just click on, is that actually in the period of rapid change that Wambui talked about, and the amount of new data that is emerging through the digitization of a lot of these processes, the new data that's coming from these digital transactions can actually help us in a way, and not solve for these problems in any sense, but actually help us chip away at a lot of these challenges. And I'm going to just talk a little bit about how that might work in the next slide. So when we think of what credit scoring does, what we're really trying to do is predict the future. What is the probability? What is the risk of this person being able to repay a loan, or conversely defaulting on a loan? What is that repayment risk? And to do that, obviously we can't predict the future, but what we can do is look at the past and we can look at the present. And the traditional way of doing that is to look at past behaviors, so transaction record, repayment records, how much have they borrowed in the past, how much do people have in their accounts, what can we tell by past financial and non-financial behaviors about a person's likelihood to repay. And then we can also look at the present, so anyone who's ever applied for a loan, well, no, there's questions you've got to fill in about where you live and what your job is and your level of education and your family size. All of this goes into credit scoring models, and we work out which of these factors correlates with high repayment, correlates with low repayment. And banks have been doing this for years. I mean, decades and centuries. In fact, banks have been making loans, and one of the kind of heuristics that people talk about is the 5 C's of credit, which is not a kind of a hard and fast framework at all, but I think it's useful to understand what a loan officer traditionally thinks about when making a loan. And we can break these into 5 C's. So first, capacity. The person likely to have the ability, ability in other senses to act. Secondly, will they have the cash flow? Particularly when we're talking about agriculture, cash flow can be very lumpy, unpredictable. What can we make a judgment based on the money we see going in and coming out of their account that they will be able to repay when they need to? Thirdly, character. And this is, one of the hardest things to digitize, because often loans are made, the traditional way of lending is loans are made by people to people. And when people meet, they make assessments of each other's character. So this is something that, has always gone into the lending process. Fourthly, conditions. So regardless of how great someone's character or capacity is, if they're kind of macro environmental conditions, mean that we're at a point in the business cycle perhaps that means that they might not be able to make repayments on time. That's also something that needs to be taken into consideration. And lastly, of course, collateral. If a repayment isn't made, is there something that can be monetized to at least partly pay for that loan? So those 5 C's are quite a useful way of just about making credit decisions, and credit scoring is a way to automate this by the use of data. And so just on to the final slide that I have. So I'm thinking about the kinds of data that gets used to make these decisions, to get away from a person lending to a person, to build data-driven models. The traditional way, as I mentioned before, is to look at you've got historical data, how have borrowers performed before on previous loans, transactional data from bank accounts, from financial transactions, and the applicant data. But obviously there's a problem here, because we're talking about financial inclusion, we're talking about lending to people who haven't borrowed before. And we know, everyone in the industry knows, that the best predictor of whether somebody will repay a loan is whether they've repaid a loan in the past. So if we have historical loan performance data, that is wonderful. But what if we don't have that? What can we use as a proxy for that that will help us try and predict risk in the future? And so I've kind of bucketed these into 3 areas that are specific to what the fund is doing. So we're seeing a lot of innovation through the fund and globally in how we can use data from utility payments. If somebody regularly pays their water bill, electricity bill on time, month by month, it's a pretty good predictor that they are able to gather enough cash flow into their account at the right time of the month to make repayments. CDR data, this is mobile phone records, data usage, data information which comes from generally mobile operators, and there's a lot of interesting stuff being done about how different usage patterns, different lengths of calls at different times of day correlate with the ability to actually service a loan. Linked to that, we see some interesting stuff going on social network data, the size of your social network, who you're connected with, how you use that social network. And also through psychometric profiling. So what can we, if we ask the right questions, if we frame surveys in the right way, what can we learn about people's likelihood of repaying through profiling them? And if we think about what all of these doing, we just click, is actually what we, sorry, Colin, can you just click once? So actually, we can see that a lot of what we're trying to tell here, particularly through these psychometric profiling, is about character. We're trying to see, does this person actually have the willingness? Do they want to repay? Are they likely to be a good borrower based on their behavioural characteristics? And then we can look at agricultural data, because obviously, if we are lending for agriculture, likelihood is that the money that is used to repay that loan will come from agriculture. So if we can predict agricultural income, then we probably do a pretty good job of predicting, of understanding their likelihood of repaying. So that kind of data that we see being used, stuff like value chain data. Do you have if you have a relationship with a big buyer, are you getting your payments? Are you getting big chunks of payments once a year? And can we predict that next year you will also be getting a big payment that could be used to repay a loan? There's also things like production data. The best predictor of your likely cash flow, if you're a farmer, is probably going to be what is growing in your field. And if you've produced X amount in the past, then maybe we can use that to predict you will be able to provide X in the future as well. So if we can have historical production data, historical yields, that actually tells us something about cash flow and capacity. So cash flow, can we say that in 6 months from now, this is what the farm's likely cash flow is going to be? That will tell us something about the capacity to actually repay the loan. And then thirdly, some of the more advanced stuff that's going on, and particularly through people like Apollo, who are a grantee of the fund. This is really about scaling the data that we can use, and this is very early stages. But things like satellite imaging data, passing data from large-scale data from NASA and others, soil and water maps, weather data, all of this tells us a little bit about what is grown, helps us to try and predict the likely output of a farm. And when we think about what this is doing, it's telling us a bit about collateral. What's being grown on the farm, what we can see growing, is actually a kind of soft collateral. And it tells us about the conditions. It tells, the weather is an unpredictable input to an agricultural loan, in the same way that economic cycle is a external input to a mortgage. And so we can see that what we're trying to do here isn't that different to what we've been doing in the financial sector for years. We're looking at the same heuristic, but we're using new data streams to build this and go from a human-based model to a data-led model. But one more thing to say about this is that the reason that there's 5 Cs is that these data actually complement each other a lot. It's very difficult to make a loan based just on one of the Cs. And the synergies that you get from having a lot of data rather than just really good data that tells you about one of these will allow you to do a way better job. And I think that Wambu's mentioned it, and I think it will come up from Smithsonian First Access as well, the importance of high quality data that tells you different things that complement each other. And with that, I'll hand you back to Grace.
Thank you, Howard. Thank you for those insights. Thank you for demystifying what alternative credit scoring does. I guess for a lot of the people who don't have a lot of knowledge in the space, it sounds like a big animal. So thank you for breaking it down for us. And I remember in one of our past conversations, you said something that I think stuck with me and I think is very relevant to the conversation is that when it comes to smallholder farmers, everyone talks about big data, but there is no big data as such for smallholder farmers. And the trick is figuring out how to make use of the very little data that there is on farmers. So thank you very much for that. And that also sets the stage for the next presenter. So the next presenter is Juliet Ongwae. And Juliet Ongwae is the Chief Innovation Officer at Musoni Microfinance. Musoni Microfinance is one of our partners at the fund, and we have supported them to scale up the Kilimo Booster product, which I'm sure she's going to be speaking about. And she's responsible for managing the innovation process within Musoni. And she also has very good experience in the sector. She joined Musoni from Central Bank of Kenya, where she served for more than 10 years in projects, deploying, developing, and positioning innovative digital payment systems. Welcome, Juliet. The stage is yours.
Okay, thank you very much, Grace. In the interest of time, I think I'll just quickly introduce you to Musoni and then our Kilimo Booster product. So Musoni is a credit-only microfinance, and we've been in business since 2010. And we like to say that we are 100% cashless, basically meaning that we leverage on payment systems such as mobile money, bank to bank, anything but cash. We're also a good percentage paperless. Around 2012, we introduced digital field applications to help us onboard our clients digitally, and also to start that loan process in the field and capture all the required data and documentation through tablets. And this is something that I will come back to in terms of collecting data. Our target clients are micro entrepreneurs, and we have a good percentage of smallholder farmers, and it's a portfolio that we are strategically growing with time. So just next slide, I'll take you through the Kilimo Booster. So Kilimo Booster is a product that we have for our smallholder farmers. We used HCD approach, human-centered approach, to design this product. It took us almost a year just to understand farmers and their financial needs and be able to come up with a product that has a lot of flexibility in terms of value chains, looking at the different needs for different kinds of farmers. So it serves multiple needs. We do working capital, we do asset finance for farming equipment, and also for farmers who are trying to diversify, are in dairy or maize and want to also add dairy. It leverages a lot on technology. In the tablet, we have a cash flow analysis calculator, and with the data that we collect from farmers, we're able to stitch together a cash flow that then informs the credit assessment. Together with this, we do offer a lot of client training, looking at good agricultural practices, looking at financial literacy, and group management. And we introduced insurance, crop insurance, and livestock insurance for the different products with time. We'll just go to the next slide. So why did Musoni think about going the credit scoring way, given the complexities of financing smallholder farmers? So one of the ways was that we realized we've collected a lot of data over time, and we were not using the data to make any kind of decision. It was a lot of data looking at the loan repayment behaviors. We collect a lot of PPI data, but we were not using that to make any lending decisions or credit decisions. We therefore decided to see if there's a way we could leverage more on the data that we've been collecting. We also wanted to reduce this turnaround time. I think we all understand farmers and their needs. they're always last minute, they'll come last minute, they want inputs. We needed to be able to make credit decisions quickly. We also wanted to standardize that credit decision. If farmers are in the same value chain and are pretty similar, is there a way we could just standardize that assessment without having to send loan officers on the ground assessing one by one? And I think the biggest reason was around allowing us to be able to onboard and assess mass clients. So when it comes to working with smallholder farmers, they're usually in large groups and have different partners in that value chain. And you find that they all have one need, which is access to finance. So we were getting a lot of interest from partners who had a huge number of farmers that need access to finance. And we found that it was not feasible to send our loan officers on the ground to onboard 500 farmers. Yet our partners on the ground had already collected some minimum data that we could use. And we could also work with them to improve the data or the quality of the data and leverage more on credit scoring. So looking at our credit scoring journey, we actually tried this credit scoring both for Kilimo Booster and other products. We tried to have partners or it done externally. And from all the attempts, we've actually got very critical insight or good feedback that then led to us making a decision into trying to develop the credit scoring in-house. We also decided to phase it out in the sense that we decided to start with possibly our internal data, because as I mentioned, since 2012, we had collected data through the tablet, which meant we had all the loan cycles for our farmer digitally, and would be able to stitch together their repayment behavior. We then decided to look at the data that we've already collected internally and what other alternative data we could add to complement that. So we looked at data such as Credit Reference Bureau data, the mobile network operator data. We even had discussions around social media, psychometric, and all those kind of data. We then started building this credit scoring in-house, and some of the key findings are around, and I think it's been mentioned earlier, the strength of our internal data, which was actually very predictive. And we also got a few learning lessons around keeping a blended approach in terms of the credit scoring model. Next slide, please. So some of the challenges, the quality of the data, I think this is across board. Everybody will be mentioning this. Much as we were collecting data for about 5 years, it was not for credit scoring. And so now, working backwards, we realize that there's a lot of cleanup we've had to do with our data. So there's issues around the quality of our data. There's also issues around the deeper our outreach, the more issues we have around, say, KYC data. So you find people with IDs, national IDs that just have the year of birth, no date. Yet everyone else's has a date of birth. So what do we do with such things? We also find self-reported data, and which now throws up exceptions. So what do we do with that? We also had challenges around data, working with partners and also data from partners. We all have different end goals. So you find, yes, a partner approaches us and yes, they have data on the farmer, but some of the times it's self-reported. For us, we cannot take a self-reported ID number. We'd want you to confirm that ID number against an ID. So we've had to go back and train the partners on the kind of data we are looking for and why we need credible data to feed into the model. There's also challenges just basically around the agricultural value chain. And understanding farmers and farmers wanting to work together, wanting to meet as a group. So we cannot get rid of them having to come together and meet as a group. So conversations around then what happens when they meet. If I'm able to onboard them outside the group and I'm able to assess them outside the group. So what value add do I give them to come together as a group and meet? Things like income and land size just not always being proportional or does not tell a story. You know, saying a smallholder farmer has 1 acre or 2 acres means nothing when you're looking at the credit scoring. What's happening in the 1 acre matters and things like that. Looking at also things around crop cycles being different. So there are different behaviors for the livestock value chain vis-a-vis the cereal value chain. Or are they all farmers and should we score them the same? One has a very stable cash flow, one does not. When you bring in markets, does that feed back into the credit scoring? When there's shocks and it affects the farmer, which means it affects the repayment and possibly insurance kicks in, how then do you tell the credit scoring model that it was a shock? It's not that the farmer is not willing to repay or things like that. So looking at this market is not the easiest to score, and there's questions that come up and we keep having to look into. Next slide, please. Some of the lessons we've learned as Musoni. Definitely partnerships are critical. The data we have is not enough. So it's trying to reach out and identify who are the right partners. It's very easy to get lost in the buzz and say you want to have, you know, psychometric social data, a partner that can give you satellite data and all those things. But you need to take a step back, understand your target market, and sort of have a phased approach. So who's the right partner and to approach now, and possibly who's the right partner to approach during phase 2 and phase 3 in terms of giving you data or giving you some service around your credit scoring model. They also can take up some of the client onboarding responsibilities in terms of if you train them well, then they can collect the data for you and be able, and you can now sort of have a shared understanding in terms of onboarding. I think I mentioned this in terms of there's pros and cons towards in-house credit scoring models vis-a-vis one done externally or paying for scores. So you have to weigh and see what works for you. We insist on maintaining a high-touch and high-tech model, and conversations are just around what the high-touch looks like. So it's cannot purely be digital, and you know, everything is onboarding, assessing, client management or farmer management is digital. Yes, we can onboard and we can actually assess them using the credit score, but we need to meet the farmers. Farmers need to be met. So it's just trying to figure out that meeting, what happens during the meeting. We also are always thinking ahead. So what's beyond predictive? You know, can we go towards prescriptive? Can we anticipate some of the shocks with time? Would we be able to see and anticipate these shocks and mitigate the risks. Yeah, so I think that's it, and I'll take questions later on. I can see a few have come in.
Thank you, Juliet. That was very eye-opening. We've always, for people who don't know very much about alternative credit scoring, again, we think it's a plug and play model where you just get the data, run an algorithm, and it's able to tell you who to lend to. But clearly, we've seen there's a lot of work that goes towards it. And especially one of the key points I think I've noted is that as much as it's going towards tech, you as Musoni are still maintaining a high-touch model. So the next presenter is Nicole van der Twin. So Nicole is the co-founder and the CEO of Fast Access. And Fast Access is a software platform that helps financial institutions to use data to reach customers faster. Nicole is dedicated to increasing access to affordable capital for MSMEs and has worked in Africa, Asia, Latin America, the US, and Europe. Welcome, Nicole.
Thank you very much. So let's go on to the next slide, please. So as was mentioned, we are focused on building a scalable software platform for financial institutions to be able to digitize their credit products, and in this case, their agricultural credit products of different sorts. And so our focus was both on external sources of data that could be useful for that purpose and on the change management required for a financial institution to adopt credit scoring as a means to an end, which is to become more profitable and more scalable and grow more, reach more customers. And so we had started to it was a huge learning experience. We've gathered a lot of information and lessons about what needs to happen before credit scoring and what can happen after credit scoring. And we've learned that one important thing to start with is the right mindset about how data can drive smarter decisions across your business, not just for each loan decision, but strategic decisions, hiring decisions, all sorts of decisions that are made every day at every level of the institution, because digital transformation can impact all of those, and it's important to keep it in mind. So when I'm talking about being data-driven, what I mean is recognizing that all actions can yield data, and to be data-driven is to collect that data, internalize it, like really look at it and understand it, and use it to inform better decisions in the future. Next slide, please. So what I'm going to review is the sort of best practices as a 3-step journey that we've developed. We've tested a whole bunch of different data sources, a whole bunch of different methodologies for how to turn some complex data into a simple credit score, how to get staff to trust it and adopt it and use it, how to interact with customers in a way that allows them to understand what the impact of a score is, understand rejection, understand acceptance, etc. And we've come up with these 3 phases as the sort of best practice way for incumbent financial institutions, particularly agricultural ones, but even those with focuses on micro and SME that also have an ag product, to become data-driven. And I'm going to go through each of the phases in a little more detail to explain what the lessons were that we learned and kind of the rationale for that phase being its own distinct period. The other thing is these phases could be of almost any length. So we've seen some institutions digitize their current products really quickly and then spend, a year improving current products and haven't launched any new ones yet. And we've seen others move faster, still others move slower. So it's not that these have to be a prescribed period of time, so much as there are things that need to happen before you are ready to implement some kind of data-driven decision-making if you are currently quite a traditional lender doing things manually on paper. And then we've learned a lot about and are focused kind of on our next step about how to help partners connect with financial institutions, particularly agricultural processors and companies that have large volumes of transactional data on smallholders, to automate or automatically initiate an origination process for credit products so that those financial institutions can scale to large volumes of customers at once, a bit like Juliet was suggesting for Musoni. So, so these three phases are basically you digitize your current products, and even though it's a little counterintuitive, it's best to replicate the current process for your loan product to minimize the change management burden, because we found that change management is so expensive, so slow, so cumbersome that it prevents, in many cases, of new technology and the evolution of business models. And so we've done a lot of work around how do you make that the beginning of that process easier, because once an institution has gone digital, particularly with its customer acquisition process, there's so many other benefits beyond just the ability to credit score more easily. So we're helping institutions migrate from paper, sort of manual origination to mobile devices. So we have a business-to-business platform. We do have a business-to-consumer interface as well, but for agriculture, in most cases, we are just working directly with the financial institution. So this is a web-based and mobile-based interface that they can use to migrate from paper. Once they've digitized the current products, there are a ton of ways to improve those current products as the company or the financial institution is building up a data culture. So you can have real-time reporting because everything's happening on the same platform, and you can see things like loan turnaround time that you were never aware of before. You can add in rules, eligibility criteria, build toward credit scoring, and I'll talk more about that in detail, and risk-based processes based on those rules and scores. The last stage, then, once your team has a really strong handle on the technology and is able to be nimble as your credit policy is evolving with market changes, they kind of have a data culture built up, and you have more efficient and better risk management processes in place. And so then you can increase the volume of customers who you are processing, volume of loan applicants who you're processing really quickly without taking as much risk as you would be if you jumped into launching a new product without digitizing your current products and improving them for a little while first. So this is the journey that we see as being the most profitable, and I'll explain why. Next slide, please. So when you're digitizing your current loan products, the lessons that we've learned about this, and the reason that we say this needs to happen first, and we've found this is it's more profitable and less risky and less expensive if this happens first, is that internal data is predictive and it's cost effective. You're already collecting it, and unfortunately, a lot of it stays on paper, but when we analyze a good internal data set, it always reveals valuable patterns, both for credit decisions and a lot of other things about the business. Unfortunately, because most internal data is still on paper, it's very hard to analyze, and it's not cost effective to go back and digitize what was on paper in the past. It just ends up being too expensive in practice. And so we found as an institution is hoping to be more data driven, starting to digitize their current loan products today, and doing that going forward pretty quickly builds them a very strong data set that they can use going forward. So data is really an asset. We also found that most core banking systems aren't sufficiently flexible with their origination tools to actually match up to what most institutions need and are doing on paper, because those underwriting processes have been developed and honed over years and years, sometimes decades, and they reflect a lot of the institution's unique knowledge and intellectual property. And so for an institution to abandon those paper processes in favor of a static module in their core banking system that does origination only one way doesn't really make sense. So we think that's one of the reasons that a lot of origination still happens on paper, even where there is a will to do it digitally. And so we found that we actually needed to build out those features ourselves and make our platform a lot more flexible so that we could essentially learn an institution's current processes and replicate them on the platform very quickly and easily. As I said, we also found that adopting new technology just tends to come with this huge change management burden. And a lot of it is quite static. And so it doesn't allow easy and affordable changes over time. And every credit business needs to change, right? There are so many, market changes, competition, regulations, environmental changes related to agriculture, macroeconomics, et cetera. All these changes can happen and you need to be very nimble. And if you're still doing your customer acquisition on paper, then you've got to circulate word memos to your branches and hope that your management team can enforce all of the changes quickly and easily. But a digital platform will do that for you. And it ends up being so much radically easier that we found digitizing the status quo and then being able to make those changes as you need to is much easier. So the more easily and the more closely a system can replicate the status quo, the easier it is to learn. And we've determined that configurable systems, basically flexible ones that have a ton of options already built in, are the only ones that are actually affordable and flexible enough to do this. So it doesn't make sense to build something from scratch that's hard coded because it will be very expensive to change later, even if you get it right when you first build it, which is rare. So the bottom line for this phase that we've learned through all our research and development is that digitizing the status quo is more affordable than trying to learn some new process associated with a new technology, because it reduces the training needs and it generates a reliable data set to inform smarter decisions about how to evolve your business. And that last bit is important too, because if you were to implement a scoring model while you're still using paper, that model is not likely based on reliable enough data from your institution's and loan product specific experience, which means you end up making a lot of assumptions. And those assumptions may not be correct, unfortunately. And so digitizing the status quo allows you to have real data on how the business is actually functioning today in terms of customer acquisition, and a lot of insights that people don't normally have access to, particularly in microfinance institutions and commercial banks that have agricultural products. So we came to the very clear conclusion that even if your current loan products and underwriting is not great, or it's a little redundant, a little cumbersome, digitize that first, because that first step is the toughest part. And if your staff can adopt it quickly because it matches their current roles and responsibilities, then it's much easier to make changes later. So phase two, you can go to the next slide. There are a few really important lessons here. So as I was just saying, as you digitize, you generate much better data on your clients, your operations, and your staff. We found about 95% of customer data, especially in agriculture, stays on paper or in individual Excel files per loan, which means it can't really be aggregated and analyzed easily. So once you start generating all this data in real time, it's radically different because your managers can really see what's going on, and they're capable, they know what they're doing, but they've always been operating with limited information if you're still doing manual customer acquisition. And so what that means is suddenly they can see what the actual loan turnaround time is very easily, what the eligibility rate is, who's not eligible and why are people actually being rejected after the whole underwriting process goes to a credit committee. How can you save time? So there are all these insights and kind of clear evidence that emerges of how you can evolve. And you can start with simple things like business rules and eligibility criteria, and then you can add scoring if you're not doing it already. We found very clear evidence that if you're not doing credit scoring yet, you should digitize your customer acquisition first, the way it currently is done, before you add in scoring, because that scoring should be informed by better data. And so, as I mentioned, it's radically easier to implement changes to a digitized business. The first time that our clients were implementing changes, it was responding to a drought that had affected the beef industry in Tanzania. And they said, oh my gosh, the change managed itself. Like they put in a change to prevent loans related to the beef industry for a temporary period to avoid that risk. And everyone, their whole staff understood, and no loans were made to that industry. Like the policy was perfectly enforced. And that was really exciting to them because it's hard to enforce if you're just using paper and people. The next thing that's important to know is from an analysis perspective, you should start with business rules that are very transparent and clear and that your loan officers can understand and explain to customers and trust so that they'll actually use them. Then weighted scorecards where you're looking at a few different factors and you weight them differently and you take a different action based on the score. Then something a little more advanced like regressions, and then only after those things is it cost effective and will it really move the needle to have more complex algorithms that use external data. The next thing is when you've got some sort of score, some kind of decision recommended or some kind of risk level that is predicted, what do you do with it? So we found that risk-based processes were much more practical and easy to implement for a large staff than risk-based pricing, where you would say that since this person's risk level is, B or whatever your scale is, their interest rate should be 3.5% instead of 3.2%. It's much easier to say, since this person's risk level is very low, we're going to fast track their approval, or since it's very high, we're going to fast track declining the loan. So adjusting your processes based on risk level is by far easier to do first, and you can evolve toward risk-based pricing as you're more automated. We also did a lot of testing with machine learning, and we found that for institutions that are getting to be a little more advanced and that have a huge amount of data, machine learning is good to identify variables, but then those variables will, the outcome will be more stable if those variables are put into a regression, which is a more kind of tried and true and simpler structure than in an actual machine learning model. So we don't recommend machine learning models for the actual loan decisions unless you're doing a 100% automated loan that is completely digital. And even then it takes a while to build up toward that, and you really need a data scientist on staff who's dedicated to it. So machine learning can be great to identify variables that you might not think to test otherwise in your internal data. But putting those variables then into a regression structure works quite well. We also found, very importantly, that teams build a data culture when they start to see smart process change from simple calculations. And we really encourage people to not make complex calculations that result in process changes early on in the digitization journey, because it's those simple calculations like saying, look, this customer has only ever had 2 late days and she's repaid 6 loans. Let's fast track her approval and skip the credit committee. Those are the kinds of things where as staff start seeing that implemented, they feel a lot of trust and buy-in and start to really understand data as an asset and get this mindset where they are able to use data more regularly to improve a lot of dimensions of the business, not just loan decisions. The other thing is that it took some of our clients a little time to understand that their portfolio, even if they're credit scoring, and the credit scoring works well in the sense that it's accurate, the quality of their portfolio won't change unless they are actually rejecting the people who are high risk, the loans that are high risk. And then their volume goes down a bit. And so they do need to be able to market more and bring in clients or loan applicants faster to keep up their volume. The other piece is, the last piece here is that we found the easiest place to start for these kinds of process changes is fast tracking repeat customers, because those evaluations are often still costly and time consuming to the institution and they cause delays for the borrower. So if you fast track them, it's both low risk, your staff will trust it, it's cheaper, you acquire those repeat loans faster, and you increase customer satisfaction. So that was the sort of point of least friction of all the things that we tested in the evolution toward credit scoring, and what to do with credit scores early on. So the bottom line here is just, oh, sorry, can you go back one? The bottom line here is that the system is actually more important than the volume of data or the complexity of the math and the analysis that you're using. And that system needs to have conditional processes. So like based on this piece of information, a process changes. Based on a customer being very high risk, the loan is declined. Based on a customer being very low risk, it's approved, for example. Okay, next slide.
Very good.
This is the last section. So this is sort of what we're working on recently. Sorry, someone needs to turn off their microphone. So we found that there was a big mindset shift when institutions would measure customer acquisition cost and lifetime value, because once you realize what they are, it starts generating a lot of ideas about how you can increase lifetime value of the customer, particularly with upselling and cross-selling, and how you can reduce the customer acquisition cost. Once your origination is more efficient, then you can increase the throughput of new loan applicants at a much lower risk. So launching things like fully digital loan products is much more profitable when done after phases 1 and 2. External data are the most relevant for agriculture and other products in phase 3. And we found that distribution partners for financial institutions that have farmers' KYC and transactional data and those relationships are the most valuable, partially just because they are a channel to those customers. It's hard to fully automate the agricultural credit decisions in those cases, but what you can do is get the data they have and in bulk do kind of mass pre-approval or pre-qualification, send notifications to the smallholders via one channel or another to allow them to apply for a loan, collect more data through their application, whether that's via SMS or a call center or a site visit or an agent or whatever, and that can lead to a credit decision. So that does allow a partner like an agricultural processor to become a very efficient channel partner for a financial institution. We also found there are ways to add incentives to repay and disincentives to default and to remove risk from a life cycle. Like if you're not dispersing a cash loan, but instead paying the provider of agricultural inputs, and then the inputs are provided to the smallholder. Incentives to repay could be things like a raffle, where if you pay on time, you get your name entered. Disincentives to default can have to do with just the downside of defaulting and making sure that customers understand that. So whether it's being reported to a credit bureau or the inability to get a loan in the future from this same financial institution, the more those things are clear to borrowers, the bigger impact they have. And that matters that can make a difference alongside things like credit scoring. And in general, focus staff on tasks that require human judgment and a human touch. So like credit decisions and some customer service needs are best for that. But a lot of other things can be automated. So as you think about becoming more and more data-driven, more and more automated, the goal is not to reduce your staff size necessarily, but increase the capacity of every staff member. And the more you add in automation, the more they can focus on the kind of meaningful stuff where judgment or a human touch is required. So the last couple of lessons are that sustainable growth comes from being able to identify and acquire low-risk customers quickly and at a low cost. So that needs to be kind of the North Star for the process of going digital. And we really just found that incremental change is more profitable because it's less expensive and lower risk, but it requires very flexible systems and this relentless focus on sustainable growth. All right, that is it. Thank you very much.
Thank you, Nicole, for that very informative session where we've all learned a little bit more about how to go about alternative credit scoring. So now we have a few minutes for question time. We have some questions that have been sent through to us. So Grace Odwor will ask the question. Okay, so the first question is to Juliet. And in the use of a blended approach, what other data sources do you consider besides the credit reference bureaus?
So as mentioned earlier, we have agreed to scale back. So we only use the credit reference bureau data and some data from the PPI surveys that we conduct and MNO. And then we decide to phase that. So once we are happy with that model for now, we can then add in alternative data.
Okay, thank you. Thank you, Juliet. So I guess the next question is kind of related, and it has to do with data integrity. And the question is, how do you take care of data integrity with most of the agricultural data being reported data? So I think anyone can take this question. Howard, do you want to go? Sorry.
I could say something, but I would say Nicole and Julia are probably a better placed than me.
I'll take it. It was one of the challenges I mentioned about self-reported data. So we had this set of data that we were very confident about, but it was self-reported. And so when we put it through the statistical models, we were getting exceptions. So it's just conversations around how best to collect that data and validate it.
Okay, thanks, Juliet. So Howard, this one goes to you. How many data points would be adequate to yield a good credit scoring model? Testing predictability of a smallholder farmer.
Yeah, I mean, that's a Grace, I think you need to mute your mic while you're talking. Yeah, this is better. So yeah, it's a question that gets asked a lot. And I don't think that I can give a number, but the number is generally a lot more than any company that is currently trying to lend to smallholder farmers exclusively with data. Currently, I think, has access to. If you want to build a robust model based exclusively on data, that is trying to tell you about all of these aspects of borrower's behavior and likelihood of repaying. You're talking about a lot, thousands of data points. And the issue with building a credit scoring model is, in order to build the model robustly, you need to have enough loan defaults in the first place to build a model. So it's a little bit of a chicken and egg situation in which you need, in order to build and backtest a model, you need a lot of loan defaults, and so you need to have made a lot of loans. Maybe Nicole and Julia have kind of more specific answers,
Yeah.
but the answer is
yeah. We generally this is sort of the ultimate question that nobody has a very exact answer to, but I would say you need to have 2 full loan cycles completed at least, with a pretty substantial number of borrowers, definitely in the thousands. And the more data you have on each person, the more likely you are to see patterns. That said, if you've got, let's say, 40 data points on each person, which is not that much, but you've got 50,000 matured loans, you are likely to see patterns as well. But we definitely found that you need sort of 5 to 15% of those loans to have defaulted to be able to see clear enough patterns that you can distinguish people who defaulted from people who didn't. So that's, those are all slightly arbitrary, but they're sort of roughly in the range of what we've seen.
Thanks, Nicole and Howard. So probably just to continue with you, Nicole, there's a question that's directed to you. So in the 3 phases that you described, how long do you think a microfinance institution should take in each of the phases?
Great question. We've seen a lot of variation, and we also are still in the early stages of this with a lot of institutions. So I would say companies that are a bit younger and tend to have some sort of cloud-based technology already move a little faster. But in general, a microfinance institution using something like Orbit R as its core banking system, and that has, a few dozen branches or more, that first phase we get the platform up and running in about 3 or 4 weeks, which is quite fast. And then they will usually roll out in a staggered fashion to their branches in groups. And that first phase is usually 6 months to a year. And then the second phase could go on for a very long time because there's a lot of room to improve once you have access to all of your data. But I would say generally 2 full loan cycles of that phase, of phase 2. So whatever your loan maturity is, if it's 12 months, you might spend 2 years in phase 2. If you're doing 3-month loans, you're actually getting sort of outcomes every 3 months. And so you can learn a lot faster and implement changes faster as a result. So, so usually a couple, like 2x your loan maturity for a given loan product would be in phase 2. And over the course of that time, you would be a lot more ready for phase 3, where you can start doing things on a much more automated basis. And we get to see financial institutions starting to have an online loan application that they link to social media ads and things like that, which is not as relevant for agriculture, but for some other loan products like micro and SMEs. And then for the case of ag, to start exploring partnerships where you can start doing mass pre-approvals and reaching smallholder customers through a partner. So yeah, I would say kind of 6 months to a year for phase 1. Could be less than that if you're moving quite quickly, and maybe if you're a more nimble institution already. And then phase 2, 2 times your loan cycle at least, because you will learn so much over that period. And then phase 3 is sort of the sky is the limit. You can do a lot.
Thanks, Nicole. So the next question is to Juliet, and I'll combine 2 questions in one. How do you verify the national IDs, and do you have any comments on internal capacity needs?
So for us, the national IDs is a service that's already handled by the Credit Reference Bureau that we're integrated with. So every time we pull data by sharing the national ID, they themselves are connected to IPRS, which is our national registration service. And from there, they're able to validate that ID number. So we didn't have to do that for ourselves. So we just get it through our Credit Reference Bureau. Second one was around the resources we need.
Internal capacity needs. Any comments?
Internal capacity needs. Yes. Definitely data scientists is a must. Is something you will need internally. Agribusiness specialists who understand the different value chains very well, so that they can advise as you're building the credit scoring models. Yeah, I think critical is the data scientist.
Thanks, Juliet. So the next one, I'll leave it open because it's very interesting that we have not had any of the presenters mention the government. So where should the government come in terms of data ownership?
I have some opinions about that. First, somebody else can jump in. I think it's the ideal role of government to enforce the fact that privacy should be considered as a very serious issue, and to ensure some standards of data security, and that consumers own their own data and should have the ability to access it. And even in the long run, I mean, this is not going to happen in some of these East African markets anytime too soon, but to be able to request it from any institution that holds it, and also request to have it deleted. So I think, when we look at GDPR, at least from the first access perspective, we consider that to be a really, really valuable, pioneering effort at giving people more control over their data. And I think, it cannot be left to individual companies to enforce those sorts of things, although some take it more seriously than others. But it should be the role of the regulator to ensure that there are clear laws and penalties for not having enough data security, and that having some kind of user-friendly mechanism to request information about what a company knows about you and what they're doing with that, that needs to be clear as well.
Yeah, if I can just add quickly to that, I agree with everything Nicole said. I mean, using the example of where I'm based in India, where a lot of you know about what the government's done on national ID and the Aadhaar and the India stack. So the government's role there has really been to build the entire public digital infrastructure on which a lot of these data flows run through. And then the idea is that you leave it to the private sector to kind of build on top of that. But with that, if that's going to be government's role, then there's a huge responsibility to manage the privacy of that data and ensure that, I think it's complicated, but I think the general principle needs to be, as Nicole said, that the data belongs to the individual. It doesn't belong to the government, and the private sector doesn't have rights of access to it without well-designed consents from the customers themselves. And so the government's role is, to regulate. It might be to build, but it's very important, and I think GDPR sets a great standard in ensuring that the data is actually the property of the individual.
Sure, and just to add on to what both Howard and Nicole have said, it's a very interesting question, because aside from the issue of data security and protecting the individual or the borrower, it's also, the data is of great interest as well from a public policy perspective. So I think there is a challenge there. And what we are also seeing as well in many African countries is that the governments themselves are going ahead and launching their own initiatives to collect their own data around, especially smallholder farmers or the agricultural community. So this is being done in Kenya, it's been done in Nigeria, and it's been done in Rwanda, and I'm sure it's going to spread far and across. So the same, they will have also interesting data points as well.
Thank you, everyone.
I can also chip in. And beyond the data privacy, I think what I'm also seeing is government coming in to support, and I think they said it before, a shared database. So you find an institution like CIS Kenya that's having conversation with the different credit reference bureaus to see if they can build a shared database that we can all plug in, because it gets very expensive to get a 360 view of a customer. So if you're going to use alternative data, you can imagine if you have to pull data from 3 credit reference bureaus for each customer that you want to score, so that you can just have a 360 view of any credits that they have or their performance of their other loans. So I think being able to offer some kind of shared database that then is commercialized would be ideal.
Thanks. I'm conscious of the time. We have 2 minutes. We have 2 more questions. I think we can quickly take one because it's been asked twice. So the person is asking, are there any examples of financial service providers that have built a strong portfolio only on alternative credit scoring without field visits, so with reduced human touch?
Not for agriculture, so far as I'm aware.
I agree. Not Musoni and not anytime soon. We believe that the touch is necessary for smallholder farmers.
Yeah, I think that's absolutely right.
Where I think we will start seeing it, other than kind of mobile nano loans, is for small businesses that are doing things like being vendors for an e-commerce platform, for example, where the majority of their transactions are digitized and visible, and the e-commerce platform or a financial institution partnering with it can see that regular transaction history. and would be willing to take the risk to finance it. But you know, as far as agriculture, I haven't seen anything really approaching this at all.
Maybe looking at agrovets. So they are in that value chain, but it's still almost like a business loan. And if they have good records, I think with time, maybe that's something where we can have the digital scoring model without any client visit.
Thank you. So due to time, we have to close there, but we will send the presentation round to all who attended the webinar. Thank you very much, both to the presenters and to everyone who attended. And we look forward to having you in our next webinar. So please please keep checking our website, and we'll announce when you have the next one. Thank you.